Hi, everyone. Thank you for joining us today for our presentation on effective buy-sell agreements for AE firms. Here's a little background about myself. My name is Sam Lyon, and I'm a tax partner at Danable and McKee LLP. I am responsible for overseeing tax engagements for a variety of clientele with a focus on the architecture and engineering industry. I am also involved as a principal in the firm's sister company, Danable McKee and Associates Ltd., where I am involved in business valuation and succession planning services for architecture and engineering firms. Here's my contact information, as well as a link to our firm's websites. So I'd like to start off with a little bit of history about our firm, Danable and McKee LLP. Danable and McKee is a full-service CPA firm that delivers to our clients. We are committed to personal, responsive service. Our clientele consists of companies across New York State and the United States and represents a diversity of business enterprises, from architecture and engineering firms to construction to automotive dealers to manufacturers. Danable McKee is headquartered in Syracuse, New York, and has additional offices in Binghamton, New York, Schenectady, New York, Auburn, New York, and Tampa, Florida. We provide assurance, accounting, tax, forensic, valuation, and advisory services to our clients. Here's a little bit of information on our sister firm, Danable McKee and Associates Ltd. For over 40 years, our consultants have worked with AE firms throughout the country in determining the fair market value of their firm, developing creative strategies for ownership transfer, and establishing buy-sell agreements among the owners to ensure success in the ownership transition process. And here's a link to that website. I like to start this presentation off with the following quote, as I think that it perfectly summarizes what our objectives are and what we want for an effective buy-sell agreement. Planning is bringing the future into the present so that you can do something about it now. With proper plans in place, ownership transition and succession of your business can be achieved. So we have some important and interesting statistics regarding the shifting of the workforce in the near future. So what are baby boomers? The 78 million people in the United States born between January 1st, 1946 and December 31st, 1964. Beginning on January 1st, 2011, 10,000 baby boomers will reach the age of 65 every day for the next 19 years. Approximately 9% of baby boomer generation are business owners. So why is this important? Because approximately 7 million baby boomer companies in the United States are estimated to be transitioned during this period. And for a lot of these business owners, this is the main source of their retirement income that they are counting on. The Exit Planning Institute has projected that over the next 12 to 15 years, more than 8 million closely held United States companies will be sold. This shows us why it is now more important than ever to have a proper succession plan for your business in place. And a question popped up in the chat. I had forgot to mention that yes, the recording will be made available with the slides after the presentation. So in 2021, PwC updated its family business survey, which surveyed nearly 3,000 closely held owners and managers. This survey indicated that only 30% of the businesses have a robust succession plan, which is a documented and communicated leadership transition strategy formally in place. This is up from 15% in 2018. According to PwC's Global Next Gen Survey 2022, this number has doubled again to 61%. So these statistics are promising, as it shows that more and more businesses are recognizing the importance of a succession plan, but we would like to see that continue to increase. So now let's talk about the need for a review of existing buy-sell agreements. So companies with buy-sell agreements already in place should undertake a detailed review of the agreement annually to ensure that the agreement does not yield unintended consequences relating to transferability, valuation, funding, or corporate governance. So you want to make sure that your business succession plan team that we will discuss in the next couple of slides are all tuned in to ensure a successful operation of the plan is in place. So changing economic conditions nationally, regionally, or within a particular company, coupled with ever-changing federal and state tax laws and rates, also mandate a periodic review of existing buy-sell agreements. This year in particular comes with a presidential election, and depending on the outcome, the federal and state tax laws and rates will likely change, so it is important to review your buy-sell agreement to account for any of these changes. So here are the four major components of a business succession plan that businesses need to think about: ownership transfer, leadership development, governance, and management succession. So first, we'll take a look at ownership transfer, which is made up of valuation, structure and funding, and the buy-sell agreement. So with valuation, how is the firm valued overall for these transactions? The structure and funding. Are you going to require that the new owners take on bank loans or outside funding, or are you going to fund the transition through payroll bonuses? And then the buy-sell agreement. Is there one in place? And if so, is it up to date? The second step is leadership development. So you want to make sure that the owners that you have identified and have in place are going to be able to take on the roles that the current leadership has in place. And this includes on-the-job training, delegating responsibility, and mentoring and coaching. So again, just making sure the proper team is in place with the proper technical knowledge and licensing requirements, especially for CPA firms like Daniel McKee or architecture and engineering firms like we're talking about here. And the mentoring and coaching is one of the most important ones in the leadership development, because you want to make sure that that next level of leaders is going to be able to step in and have the technical competence to be able to run the company. Number three is governance, which is made up of corporate structure, management control, or management structure and control. So this can get messy without a plan in place, because sometimes founding owners can have a hard time giving up control. So you want to make sure that everything is laid out clearly in a plan and able to be funded and operated. And the last one is management succession, which includes admin and finance tasks, operations, and sales as marketing. As a business owner, you have to be able to focus a lot of time in these areas as well to run a successful business. So it is not all just about bringing on new owners that are technically competent. They also have to be able to have these skills to run the firm successfully. So I always think that this is one of the most important slides in the entire presentation. The successful ownership transition planning is a team sport. So what do I mean by that? It is crucial that everyone listed below is keyed in on the plan from the start and on the same page. So that includes your CPA, your attorney, your financial planner, your insurance agent, and your valuation expert. So every person on this diagram brings a different skill set to the table, but they may affect one another. So the valuation expert can assist with developing a buy-sell agreement, for example, but a lawyer will have to review it, and the CPA should too. I have seen examples in practice where everyone wasn't on the same page and it doesn't turn out good. So here we have the three phases of the internal ownership transition process. And we always like to talk in practice to our clients about, we don't want to put the cart before the horse. So a lot of the times when we get engaged by clients to perform valuation work and ownership transition work, the clients always want to start with the ownership transition plan first to see how they can get that through. But you really have to work through these three phases in order to make sure that the plan and the valuation and the value that you come up with is correct. So looking at phase one, the valuation, we want to establish the current value of the company. So this is going to be the purchase price used for the ownership transfer for that year. This also aids in projecting the value over the term of the plan. So we can project over 10 to 15 years with a growth rate estimated to see what the transition is going to look like over a period of time. It also estimates the dollars that are going to be transitioned. So how much will the buyers need to successfully fund the transition and purchase the seller's interest? Phase 2 is the transition plan structure. So this is made up of identifying the goals of existing owners, family members, and key employees. So this phase would include interviews and questionnaires with management, current owners, and future owners to kind of get their goals and plans in place. This will help us develop a plan structure that meshes these goals for everybody involved. And it also addresses key elements of timing, funding, affordability, and taxes. So with timing, when is the transactions going to take place? When are current owners looking to sell down and retire? Funding, where is the money coming from for the transition plan? And affordability and taxes, is the cash flow to the company feasible? And then phase 3 is the buy-sell agreement. So this incorporates key elements of valuation and transition plan structure, provides legal substance to transition plan, and eliminates confusion in the event of death, disability, retirement, or separation from service of a current or future owner. So examples from this in practice would be if a founding owner dies or becomes disabled, who is next in line to come in and step in and take over the business? So I have seen this in real life with the firms who have a solid succession plan in place and the business did not miss a beat. So let's talk about internal ownership transition plans. When owners of closely held companies approach retirement, they have common questions that they may ask themselves listed below. Who should be admitted as new owners? So are they competent people you want to be in business with going forward? What percentage ownership should I sell? That you have to look at whether you want to retain a controlling interest, and if you're selling a minority interest, if there's voting rights involved or not in non-voting rights involved, all important characteristics to consider. When should I retire as a founding or main owner? So your age and your life goals, where the funds come from to purchase my ownership interests. As previously discussed, are they going to come as bonuses from firm profits? Are you going to require new owners to take out bank loans by themselves to fund this? Why should I sell my interest and relinquish control of the company? And how should the sale be structured? And this can have certain tax implications to both the buyers and the sellers, whether it's a stock sale or an asset sale. So long-term strategic ownership transition plans are designed to answer these questions and provide a framework for ownership transition within a company, which addresses both foreseen and unforeseen events. So as previously discussed, a sudden death or disability of an owner can cause harm to running a business if a proper plan is not in place. As each company is unique, so too is each ownership transition plan. So there is no standard ownership transition plan. What works for one firm may not work for another. So now we can dive deeper into the buy-sell agreement. So a mandatory step in the plan for ownership transition is the adoption of a comprehensive agreement among the shareholders that is often referred to as the buy-sell agreement. So the buy-sell agreement is a contract providing for the sale of shareholders' ownership interest in the company upon the occurrence of a specific event. Commonly referred to as events of transfer, these include retirement, which could be a mandatory retirement age in the agreement, death, disability, or separation from services, which could be voluntary, which is the owner leaving on their own terms to pursue other opportunities, or involuntary, which could be there was a termination for cause of a shareholder. Other events of transfer can include bankruptcy, divorce, conviction of a crime, especially a felony, loss of professional license or accreditation, loss of residency status. All of these things should be properly addressed in your firm's buy-sell agreement to ensure successful transfer of ownership in the future. So there are generally three types of buy-sell agreements listed here. We have the cross-purchase agreement, a stock redemption agreement, and a hybrid or combination agreement. So we'll start with the cross-purchase agreement. This is a buy-sell agreement solely among owners where, for instance, upon the death of a shareholder, the remaining shareholders must purchase the stock of the deceased shareholder. So a real-life example of this would be I'm a partner at Danable and McKee. If one of my partners dies, the rest of the partners have the right to purchase the shares from the deceased partner. The next one is a stock redemption agreement. So this is an agreement in which the company, as well as the owners, are parties. In this agreement, the company agrees to buy or redeem the shareholders' interests on the occurrence of a specified event. So that same example, me being a partner in Danable and McKee, if one of my other partners dies, it wouldn't be me buying the shares from the deceased shareholder. It would be Danable and McKee, the firm, purchasing the shares from the shareholder. And the third one is a hybrid or combination agreement. In this type of agreement, the company and the shareholders agree to buy the shareholders' ownership interests, and such agreement has a provision that consists both of a cross purchase and a redemption agreement. Upon an event of transfer, other shareholders first have the right to purchase the shares, and then any remaining unsold after the right of first refusal will be redeemed by the company. This is probably the most common one that we see in practice. So an example of this would be me being a partner at Danable and McKee. One of my other partners leaves. I have the first right to purchase their shares from them. If none of the partners want to purchase the shares from them, the firm has a mandatory obligation. Danable and McKee has to purchase those shares. And on these next few slides, we will walk through examples of each of the agreements, starting with a cross-purchase agreement. So the cross-purchase is a transfer of stock that occurs between two individuals. The company is, again, not party to the transaction, and the remaining shareholders will be unaffected. So it happens essentially outside of the company. Nothing is reported on their books as far as the sale besides ownership change. So if we take a quick look at this example, you'll see we have three shareholders, Bill, Cindy, and Jim. Their beginning ownership, Bill has 500 shares, Cindy has 500 shares, and Jim has 0 shares. So the total shares at the beginning are 1,000, Bill owning 50% and Cindy owning 50%. In this example showing a cross purchase, Bill is going to sell 250 shares or 25% to Jim. So you'll see the total shares in the company in the middle column don't change, and the total ownership percentage just shifts from Bill to Jim. And then the resulting ownership percentage, Bill has 250, Cindy has 50, and Jim has 250. So the total shares of the company remain at 1,000. Bill's ownership percentage goes from 50 to 25. Jim's ownership percentage goes from 0 to 25, and Cindy remains unaffected. She's still a 50% owner. So just some advantages and other comments about cross-purchase agreements. Cross purchases of closely held stock enable the purchasing shareholders to increase their tax basis of their stock holdings, thereby reducing their individual long-term capital gain exposure when the stock is sold or otherwise transferred in the future. So if I was to buy an interest in an architecture and engineering firm for $1,000, and then when I go to sell that, I use that the original purchase price of 1,000 increases my basis. When you go to sell that, your basis reduces the sale price in your long-term capital gain. So cross purchases serve to foster internal ownership transition as individual family members and or key employees are directly purchasing stock from retiring owners. And properly structured cross-purchase transactions can result in tax-deductible alternative to ownership transition if the bonus compensation funded plan is implemented to address purchasing shareholder affordability. And an example for this would be if you have an S corporation and you're looking to transition ownership and you're funding it through bonuses given to the new owners. So the S corp will give a bonus to the new owner that they will then use to purchase the shares from the selling owner. If that bonus being run through payroll, the S corporation is going to get a tax deduction at the entity level for that bonus. And since cross-purchase transactions occur between individuals, selling shareholders may be at greater risk of potential default. However, this can be minimized with a bonus compensation fund and cross-purchase agreement, as well as corporate guarantees. And I've seen in practice, you can also use the firm as a sort of an intermediary where the payment goes directly to the selling owner. And we have seen this in partnerships. So now we can move on to the second option, which is the stock redemption agreements. We have an example here as well. So in the stock redemption, the shareholder sells his or her stock back to the company. So in contrast to the cross purchase, the remaining shareholders realize a proportionate increase in stock ownership since the issued and outstanding shares of the company are reduced. So same example starting from the cross purchase, we have Bill 25%, Cindy 50%, and Jim 25%. 1,000 total shares equal to 100%. Bill is getting his shares redeemed by the corporation at this point. So Cindy or Jim are not purchasing the shares. The firm is instead purchasing the shares to go into treasury. So Bill's shares and ownership percentage go down to 0. You'll see that Cindy and Jim, their shares don't change, but their ownership percentages increase to the proportion that Bill sold. So the resulting ownership, the number of shares decreases to 750 because the firm purchased the 250 from Bill. Cindy still owns 500 and Jim still owns 250, but their ownership percentage is increased in proportionate to what Bill sold. So some key points to the stock redemption agreements. In contrast to cross-purchase transactions, the remaining shareholders in a stock redemption do not obtain an increase or a step up in basis in their shares, even though their individual ownership percentages have increased. This is because they have not used funds or their own money to purchase any new shares. Their shares stayed the same. Everything else being equal, the remaining shareholders are in the same economic position before and after the stock agreement or redemption because they paid nothing for any of the new shares. So their number of shares isn't affected. So stock redemptions can be used in tandem with cross-purchase transactions, gifts, or stock bonuses to permit retention of voting control by existing owners or generations of owners. By themselves, the redemptions generally do not foster ownership transition as new owners are not being added to the company. So it really must be used in conjunction with gifts, cross purchases, or stock bonuses. And this is because since the firm is buying the shares, no ownership is being offered to new owners. So it's not really fostering that ownership transition and bringing on new people to take over. And stock redemptions are also not tax deductible, which creates significant tax disadvantage when compared to other ownership transition vehicles. Meaning when the firm purchases the shares, the firm does not get a tax deduction on the company return for this. Whereas if they're through the cross purchase, like we just discussed before, if that's funded through payroll bonuses, the firm gets to write off those bonuses as salary and wage expense. When the firm itself redeems the stock, they don't get any tax write-off for that. So looking at effective buy-sell agreements, some of the key objectives listed below. The buy-sell agreement should be self-executing, and it should accomplish all of these objectives, starting with to provide for an orderly transfer of ownership interest upon the death, retirement, or disability of an owner, which we've already discussed earlier in the presentation. It should restrict transferability to those not employed by the company. So what we mean by this is I can't go to the bar or a restaurant down the street during lunch and sell my interest in Danable and McKee. It also creates a market at a fair price for the interests of owners who desire to transition their ownership in the company for expansion or in contemplation of retirement. So it gives other owners the chance to buy in as well. It permits retention of control by the remaining owners, maintaining an identity of interest between ownership and management, and eliminating conflicts that might occur between owners active in management and inactive owners. It's also used to determine the value for sale and purchase price in the related payment terms, so there are no questions when the transactions come up. And it's used to reasonably assure the continuance of the business and reduce the risk of dissolution and loss of value. So if no plan is in place or without an effective buy-sell agreement, the risk of the business operating as is much higher. So looking at the offering process, as shares are available for purchase or new shares are issued under the buy-sell agreement, the agreement should provide an offering process, giving approved individuals the right to purchase shares to foster ownership transition. So many agreements, like we discussed earlier, will contain the shareholders' right to first refusal for shares that become available either as approved by the company's governing body or pro rata based on the existing stock ownership. For shares that go unpurchased under the shareholders' right of first refusal, the company will generally have a mandatory redemption obligation to redeem any remaining shares, and this provides for a continuous market for the shares of stock. Because the firm has to purchase the shares to Treasury, that means there's always a market for somebody that's looking to sell and retire. And existing agreements that provide the right of first refusal on the part of the company as opposed to the individual shareholders may be counterproductive to transition stock ownership to future generations. And why is this? It's because it doesn't really encourage new owners to come in and take over if the firm just keeps buying back all of the shares. It doesn't give any incentive for anybody else to want to come in and join as a new owner. So it's important really to have that right of first refusal in there, because that really will foster bringing on new owners into the business and continue wanting new owners wanting to be interested in buying into your business as well. So let's take a look at the restrictions on transfer. So shareholders of closely held companies often want to restrict transfer of shares by other shareholders for a variety of reasons. And this includes the desire to ensure that they know who they are investing with, to limit the number of shareholders for administrative reasons, and to ensure that competitors or other undesirable parties do not become shareholders and thereby gain access to confidential information about the company. So you don't want undesirable parties or anybody that you don't want to be in business with figuring out keys to your business success. So generally, they prefer to have stock ownership rest with family members and or individuals who are taking an active part in the business. So if you want to go into business with someone, you don't necessarily want to go into business with their spouse either. You want to make sure that you're just going into business with who you want to go in with. Professional companies in particular generally agree on and adopt a criteria for ownership, which provides a roadmap for individuals developing required technical expertise and the skills necessary as well to be admitted as new shareholders. So whether this is years of experience with the company, professional credentials for architecture and engineering, or CPA firms like us, certain criteria have to be met in order to be owners of certain businesses. And then restrictions on transfer include conveyance of shares to individuals outside the scope of the buy-sell agreement, and typically include any pledge, mortgage, encumbrance, gift, or other gratuitous assignment of the shares to anyone who is not a party to the agreement or approved by the company's governing body, including spouses, which I touched on above. And again, I can't go out to lunch today and gift my interest in Danable McKee to somebody that is not approved by the partner group. So now we can take a look at the valuation portion in the buy-sell agreement. So the agreement generally provides for a valuation of shares in any one of three different methods, which we'll discuss in more detail in the next few slides. The three include a fixed price, a fixed formula, or an appraiser driven, and there's advantages and disadvantages to each. So with the fixed price, the shares are purchased or redeemed at a price that is set in the agreement, which wouldn't be too desirable because it can't fluctuate as much up and down or change with things that change in the business or the environment and the economy. The fixed formula is most desirable and what we probably see in practice the most often, where the shares are purchased, redeemed at a price determined by a formula that's contained in the agreement. So the formula can kind of capture those changes in the business and the economy at any given time. And the third is the appraiser driven, which is the least desirable for the AE firms as it can be expensive. And then you end up having what we like to say too many cooks in the kitchen, because it's a combination of up to 3 appraisers that determine the price at which the buy sell will be executed. And we'll discuss later in the slide how that can get messy at times. So here are some advantages and disadvantages of fixed price agreements. Some advantages is it's easy to understand and easy to execute, and it's a low cost to put in place. So you come up with the fixed price, and that is kind of it kind of is what it is. So there's really no complications that go into that. So the disadvantages include the proper price only in one instance, maybe at the beginning, and it may not account for changes or other adjustments. The determination of a fixed price was it determined by an independent appraiser or kind of a back of an envelope calculation that may have been performed by management or somebody not as qualified to do the appraisal. And then once the fixed price is determined, again, it kind of is what it is. So it's hard to veer from that or have any adjustments. In its relevance on a go-forward basis, given economic climate, growth of the business, and a host of other factors impacting the valuation of a closely held company. So now here are some advantages and disadvantages of the formula agreements, which is what we see a lot of times in our practice. So the advantages, it can be incorporated into agreement so as to be easy to understand. So the formula can be part of the buy-sell agreement that everyone can see and know how the share value is calculated for the ownership transition. It's also easy to execute, and it reduces but does not eliminate the opportunity for manipulation, because you can always have owners trying to time their retirement when the price is at the highest. Some disadvantages to the formula agreement include how was the formula derived or determined? Was it an independent appraiser or back of the envelope? So was a professional hired or did management create the formula that's being used? And are the appropriate and applicable adjustments that should be included in the formula or the valuation included in the agreement so as to be looked at every year? And then also relevance on a go-forward basis, given economic climate, growth of the company, and a host of other factors impacting the valuation of a closely held business. And it needs to be revisited annually to be adjusted. So now we'll look at some advantages and disadvantages of the appraiser-driven agreements. Starting with the advantages. So it will be reflective of the current value of the company given current market conditions and economic environment, because the appraisals will look at those factors when doing the valuation. It eliminates arbitrary valuations when appraiser is independent, and you have credible results with the independent appraisers. Again, the disadvantages are timetable and cost. So this will definitely be the most expensive option and could take more time because you're trying to get potentially three different appraisers to do the same valuation on a specific time frame. So it can definitely be expensive and take more time. You may have differences in consistency in the approaches and methodologies used between appraisers, which could impact the effectiveness of the buy-sell agreement. So different appraisers may use different methodologies, which could be an issue. And it also requires management input, thought, and discussion more than the other options. So let's take a look at the summary of required elements of the buy-sell agreement. So first, looking at purchase obligation on death. So there should be a mandatory purchase by the corporation or the remaining shareholders on the death of a current owner. So this guarantees the transfer of ownership in an orderly transition from the deceased shareholder to the new owners or to the firm. So the price will be determined under a formula set forth in the buy-sell agreement. And this is usually determined by a valuation report, which could be used as, for an example, in an AE firm, we could use adjusted book value plus a goodwill portion to come up with that value. And if local law prohibits corporation purchases, shareholders should be obligated to purchase. And again, this guarantees orderly transfer of ownership, because if the shareholders aren't obligated to purchase and the corporation also is either not allowed or obligated to purchase, if somebody dies or goes to retire, there's no market for that owner to sell their shares, so they won't be able to sell and get their cash out for that. So there should also be an option upon voluntary transfer for the shareholders. If the shareholder desires to transfer his shares, he should be required to offer it to the corporation or the remaining shareholders. And again, the price should be the same formula price as used on the purchase obligations on the death. This prevents outsiders from becoming shareholders, and it can be mandatory in the agreement. So an example for this is if you have a certain retirement age in your agreement, say once you hit 65, you're required to sell down and sell your shares. So moving on to option upon involuntary transfer. So when a shareholder is forced to sell, this section will address involuntary transfers where the shareholder becomes insolvent or bankrupt and his shares pass to a trustee in bankruptcy. It also applies if a shareholder becomes incompetent and a guardian is appointed. So the shares become subject to the same options in favor of the corporation or the remaining shareholders. So this is important. So looking at purchase obligations upon termination of employment. So there should be a mandatory purchase by the corporation or the remaining shareholders. Again, we recommend that the shareholders get the right of first refusal to be able to purchase those shares, but then having a mandatory purchase by the corporation in place continues to foster the ownership transition. This includes a mandatory sale by the shareholder on the termination of his employment with the corporation. Can be an option rather than an obligation, and the price is determined by the same formula price generally, but it could consist depending on why they were terminated. If it was involuntary termination, there could be certain provisions listed in there that we'll discuss later in the presentation to kind of reduce that purchase obligation for the shareholders, existing shareholders or new shareholders coming in. So the agreement should also include an option upon permanent disability. It should address the purchase event of an owner with a serious illness for a substantial period of time. So if an owner gets in an accident or gets sick and they're out for months or years at a time, there needs to be an event in the agreement that states what's going to happen at that time. They should have a purchase option in favor of the corporation or remaining shareholders, again, upon the disability of a shareholder, and it should be mandatory. So this, again, will just continue to foster that transition between either existing shareholders or requiring that the corporation purchases the shares back to continue the ownership transition. One thing I want to point out is important in this section is to define disability. So if this is not clearly defined in the agreement, it can delay ownership transfer and disrupt operations, which would not be good for the company and the continuation of the business. And then you might want to consider tying into regular disability policies as well in this section. So the agreement, the buy-sell agreement should also clearly lay out the purchase price. This is going to be a formula price that should be described again in detail in the agreement. And for architecture and engineering firms, this could be a variety of combinations, which could include adjusted book value and goodwill set forth to come up with the value. The formula should be in an attached exhibit since the formula provisions can be complex. And you'll want to consider a certificate of value that calculates value annually to ensure the formula is still representative and makes sense for everybody involved in the process. Kind of going along with the purchase price would be the payment of the purchase price. So the agreement must provide for a mode of payment of the purchase price of shares purchased. So again, is this going to be funded through outside sources? Or is your firm going to require that you go out and obtain outside financing to purchase shares to foster the ownership transition? Or is it going to be funded through, you'll see here, we got life insurance, payroll bonuses, a bunch of different factors that can go into it. We just want to make sure that that's kind of clearly defined and laid out in the agreement, so it's set in stone and there's no questions of anything. So payment of life insurance proceeds, if any, should be used to pay down the purchase obligation first. So if an owner dies and the firm has an insurance policy on them, then when they cash in that policy, the funds received from it should be used to pay down the purchase obligation first. So any balance due after the payout of the insurance proceeds can be paid out in cash if the company or firm has enough cash flow to pay it. Or they can use a promissory installment note, and this would be just payment over a period of years that is laid out and defined in the agreement with dates and applicable interest rates as well. The notes should be attached as an exhibit as well, and they should also specify the payment amounts and the due dates. Is it going to be monthly, quarterly, or annually payments, and applicable interest rates used on these payments? So next will be the closing. We want to specify the dates of the closing of the transaction. So when will the actual transactions take place? One important note is we want to make sure the redemption takes place after the purchase of shares by the remaining shareholders. So again, we want to kind of encourage that cross-purchase ownership transition first. We also, something important is we want to avoid dividend treatment. So if you're a C corporation and you pay out dividends, these are obviously subject to double taxation and are not deductible by the company. So in contrast, if you use bonuses to fund the compensations, it'll be deductible as compensation on the tax return. Okay, so we have a legend on certificate, which notes restrictions on the transfer of the stock. So this prevents transfer of shares to bona fide purchasers free of the terms of the agreement. And most states require that a copy of the agreement be filed in the office of the corporation for it to be binding. And then we'll also want to have a section on termination or amendment. So this needs to clearly define the events which terminate the agreement. Examples of this would be bankruptcy of corporation, dissolution, written agreement of owners, etc. So we just want to make sure that those are clearly defined in a plan in place in the agreement should any of those events happen. And it also provides for the purchase of any insurance policies by a shareholder if any policies owned by the other shareholders or by the corporation if the agreement is terminated. So let's take a look at the insurance section of the buy-sell. So this will list policies in an attached exhibit of the agreement. So any policies that, like we previously mentioned, we have on existing owners, life insurance will be attached in a separate exhibit. So in the case of a corporation, it should not be obligated to continue policies in force if there is a need for working capital or a deficit in earned surplus. So they can get rid of them if needed to run the business. And individual shareholders should be obligated unless all parties to the agreement consent to change. So the shareholder should be obligated to have the insurance on them. And then key man insurance is also a consideration to replace the talents of a deceased shareholder. So this is purchase on life of owners considered critical to the business. So if upon death and we have to get rid of them at the company, there should be that key man insurance policy in place to cover their ownership transition or any loss of clientele that could potentially arise from that. Looking at use of escrow accounts. So this can make the stock purchase agreement self-executing. And this is used to ensure that upon an event of sale and purchase that the provisions are performed. An escrow agent can be used whose instructions for deposition are based on the document that he or she holds. So a responsible financial institution such as a bank or trust company can be used for this and would be recommended. So the last couple required elements of the buy-sell agreement that we'll touch on. So other valuation provisions and the spousal acknowledgement. Starting with the other valuation provisions. So the effective date of the valuation. When is the valuation and updated valuations in concurring years going to take place? So most times in practice, you'll see that this is at the end of the year or the end of the fiscal year of the firm or the company. Some other important provisions to consider would be a drag along and tag along in the event of an outside sale. So if your firm is not transitioning internally to employees and you're selling to another company, it's important to have these provisions in there. So kind of touching on the drag along provision first, this would be if majority shareholders can force minority shareholders to join in the sale of a company. So if company A wants to be acquired by company B, and there's a drag along provision in the agreement, if the majority shareholders consent to the sale, they can force the minority shareholders to join in the sale of the company. And then similarly, with the tag along provision, if there's a sale of company A to company B, the minority shareholders can sell their shares if the majority shareholders are negotiating a sale. So they can kind of tag along with the majority shareholders and sell their interests as well. Kind of another important factor included in a lot of buy-sell agreements is what we call a haircut provision for certain events of transfer. So this can reduce the buyout to the selling shareholder depending on what happens to the company. So there can be certain provisions listed in there for certain events of transfers that can change or adjust the valuation price or buyout price based on what happened. So for example, if we have a shareholder that is terminated involuntarily, they did something wrong, they could potentially have been harmful to the company, there could be a haircut provision in there saying that those type of transactions can kind of get a cut price on the transfer of ownership of their interest. And then the last one is an airbag clause to limit the redemption payments based on actual cash flow of the firm or the company. So this really just makes sure that the firm or the company has enough free cash to run the business. So if at a time there is an event of transfer that happens and the price is going to be too high and it's going to severely hurt the company's cash flow, there can be a clause in there that limits the redemption payments based on the actual cash flow of the company to make it more feasible for them to transfer that ownership. And we've kind of already touched on this a little bit in the previous slides, but spousal acknowledgement. So again, in community property states, this is a must. The spouse acknowledges that they're not owning essentially the interest that my wife would acknowledge that she is not owning an interest in Danable and McKee. I own the interest in Danable and McKee. And if anything happens to me in an event of transfer, my interest wouldn't be transferred to her. It would be transferred either back to the existing partners or the company. And this is also just a good idea for other states as well to have this in the agreement, just so it's clear, cut, and dry, and there's no confusion. Okay, so the last part of the presentation in the buy-sell agreement we're going to quickly touch on is the covenant not to compete. And you'll see that there have been some recent regulations and changes to these that will greatly affect this. So non-compete clause or covenant not to compete is a term used in contract drafting, and it refers to an agreement under which one party, which usually a shareholder, agrees to not pursue a similar profession or trade in competition against another party, usually a company. So really skipping down to the third bullet point, what I really want to touch on is the clauses. They are typically compromise, or the non-compete clauses typically are comprised of three elements. Number one is the time frame during which the shareholder is restricted. Number two, the geographical area in which the shareholder is restricted. And number three, the conduct employment with respect to which the shareholder is restricted. You just want to make sure that these are not too restrictive or they will not be enforceable. So you have to allow people to work in some capacity. You can't cut them off and say, for example, you can't work within 500 miles anywhere, north, south, east, and west of New York State. That probably wouldn't be enforceable in court. So when the shareholders or key employees of the company have significant knowledge about clients, operations, or other matters, a non-compete agreement is essential to protect the interests of the company and its remaining shareholders. So this is really the part where you don't want to give away your quote unquote secret sauce to your competitors. So you want to make sure that your day-to-day operations and running the business, the secrets that you have to create a successful business are protected. And then non-compete agreements with shareholders include specific payments over the non-competition period, which could increase the enforceability of the non-compete agreement. So an example for this would be if you had, say you're going to have $10,000 for a period of 5 years, $2,000 a year over the period of the non-compete. So the validity of these provisions are generally determined by state courts. And in a few states, and coming up in most states, you'll see in the next couple slides, non-compete agreements are unenforceable. So New York state law disfavors non-compete agreements as an unreasonable restraint of trade, but will generally enforce a non-compete if the restriction is reasonable. Which again, we kind of just touched on, where you can't say that somebody can't work 500 miles all directions around you, because that is very restrictive on them working at all. So you don't want to put people out of work for everything, but so you just have to make sure that it's reasonable. And although courts determine reasonableness on a case-by-case basis, a non-compete can be reasonable only if it is no greater than required to protect an employer's legitimate protectable interests, does not impose undue hardship on the employee, does not cause injury to the public, and is reasonable in duration and geographic scope. So again, you can't say that you practice in Syracuse that you can't go 500 miles in either direction to work. That's just not feasible. So as previously mentioned, we'll now look at the new regulations that have been in the works and coming out regarding covenant not to compete. So on July 9th, 2021, President Biden issued an executive order directing the Federal Trade Commission to curtail the unfair use of non-compete clauses and other clauses or agreements that may unfairly limit worker mobility. And then in January of 2023, there was released proposed regulations declaring most non-compete clauses and other clauses which have the effect of prohibiting competition an unfair method of competition. And then in April of 2024, the Federal Trade Commission issued final rule on non-compete clauses, which will become effective 120 days after the publication in the Federal Register. And the final rule bans non-compete clauses with employees. So as a result of this, existing non-compete agreements must be rescinded and new agreements cannot be entered into as a result of these new regulations. So it's important to note that. There are two important exceptions to the bans on covenant not to compete that were included in the final ruling. The first is existing non-competes for senior executives can remain in place. And this is based on total annual compensation and if they are in a policy-making position, which we'll touch on in the next couple slides. And then the second, the ban on non-compete clauses does not apply to agreements entered into by a person pursuant to a bona fide sale of a business entity, of the person's ownership interest in a business entity, or of all the substantially all of the business entity's operating assets. So again, with these new regulations, just looking at a couple definitions of what we just discussed, the non-compete clause is defined as a term or condition of employment that prohibits a worker from penalizes a worker for or functions to present a work from seeking or accepting work in the U.S. with a different person, where such work would begin after the conclusion of the employment that includes the term or condition, or operating a business in the U.S. after the conclusion of employment that includes the term or condition. And a definition of senior executive for that previous exclusion is defined as a worker who, as I mentioned, was in a policy-making position and received total compensation for their employment of at least $151,164. So really what we want to touch on here is that business owners should consult with their corporate counsel to ensure that the required notice to rescind existing non-compete agreements with employees is made, and to determine the enforceability of any existing agreements with senior executives. So you just want to make sure that you're on track here and everything is up to snuff with your agreements. So the last item that we'll touch on real quick is just corporate governance. Corporate governance can take time, or excuse me, corporate governance can take different forms. And this can include a board of directors, executive committee, a management committee, etc. So really just anybody or separate groups that are put into place for different functions to make sure that the firm or the company is in compliance and that everything is running the way that it should be. So whatever the structure, the company's governance will play an active role in major decisions affecting the company, including carrying out the company's buy-sell agreement. And then corporate governance needs to be incorporated in other corporate documents outside the buy-sell agreement, corporate bylaws, personnel manual, operations manual, etc. So it doesn't look like we have any questions in the chat. I had mentioned before that the slides will be available and the recording of the webinar will be available and will be sent to you soon after this presentation is over. So if nobody has any other questions, thank you for taking the time to join us. We appreciate it. And if you have any follow-up questions or want any more information from me or about our firm, feel free to visit our websites listed here or reach out via email. You can give me a call, anything like that. So with that being said, that's the end of the presentation, and thank you for joining us and have a good day.